Hey everyone, welcome back to the channel. Today we're tackling a question that's been on a lot of people's minds. Are we headed for another housing market crash like the one in 2008? It's a scary thought, right? You see headlines about high mortgage rates and cooling prices, and it's easy to feel a sense of déjà vu. But is 2026 really a repeat of 2008? Let's break it down, look at the facts, and separate the fear from the reality. By the end of this video, you'll have a much clearer picture of what's actually happening in the US housing market. So, stick around. First, let's take a trip back to 2008. To understand why today is different, we have to remember just how unique that crisis was. The 2008 crash wasn't just a simple market downturn, it was a complete meltdown of the financial system, with housing at its epicenter. The core of the problem was reckless lending. Think about it. You had something called subprime mortgages being handed out like candy. These were loans given to borrowers with poor credit history, often with little to no documentation required. They were called ninja loans for a reason. No income, no job or assets. Lenders weren't too concerned because they would just bundle these risky mortgages together into complex financial products called mortgage-backed securities and sell them off to investors, passing the risk down the line. This created a massive artificial demand for housing. Everyone thought they could get a piece of the American dream, and easy credit fueled a speculative frenzy. People were buying multiple homes, not to live in, but to flip for a quick profit. Home prices skyrocketed, completely detached from fundamental economic factors like wages and job growth. It was a classic bubble built on a foundation of bad debt and pure speculation. When homeowners inevitably started defaulting on loans they could never afford in the first place, the whole house of cards came tumbling down. The value of those mortgage-backed securities plummeted, major financial institutions failed, credit markets froze, and the entire global economy was dragged into a severe recession. Home prices fell by over 30% nationally, wiping out trillions of dollars in household wealth. It was a perfect storm, a systemic failure. Now, let's fast forward to today, to the market of 2026. As we look around, it's easy to see why people are getting nervous. Mortgage rates are significantly higher than they were just a few years ago. This has made buying a home incredibly expensive for the average person. Affordability is at one of its lowest points in decades. In some of the hottest markets, places that saw insane price growth during the pandemic, we are seeing prices start to cool off or even decline slightly. So you've got high rates, stretched affordability, and some price corrections. It sounds like the beginning of the end, doesn't it? Well, not so fast. When you look beneath the surface, the fundamental structure of the market today is worlds apart from 2008. Let's talk about the biggest difference: lending standards. This is the absolute key. After the 2008 disaster, regulations were put in place to prevent that kind of reckless lending from ever happening again. Laws like the Dodd-Frank Act created strict rules for mortgage lenders. Today, getting a mortgage requires real proof. Lenders meticulously verify your income, your assets, your employment, and your credit score. The subprime loans that fueled the last crisis are virtually extinct. The average credit score for a new mortgage holder today is in the mid to high 700s, which is considered very good. This means that the people who own homes today are by and large well-qualified borrowers who can actually afford their monthly payments. We've moved from a market built on risky bets to one built on financial stability. Another huge factor is homeowner equity. In the lead-up to 2008, many people bought homes with little to no money down. When prices fell, they were instantly underwater, meaning they owed more on their mortgage than their home was worth. This gave them a huge incentive to just walk away and foreclose. Today, the situation is the complete opposite. Because of the massive run-up in home values over the last decade, the vast majority of homeowners are sitting on a mountain of equity. We're talking about trillions of dollars in collective home equity. This acts as a massive financial cushion. Even if prices were to drop by 10 or even 20%, most homeowners would still have a significant equity stake in their property. They have a powerful incentive to keep making their payments and hold on to their asset, not to default. This equity buffer is a critical stabilizing force that simply did not exist back in 2008. And what about the banks? In 2008, major financial institutions were highly leveraged and deeply exposed to the toxic mortgage-backed securities. When the housing market collapsed, it triggered a chain reaction that brought the banking system to its knees. Today, thanks again to post-crisis regulations, banks are in a much stronger position. They are required to hold significantly more capital in reserve to absorb potential losses. They undergo regular stress tests to ensure they can withstand a severe economic downturn, including a sharp drop in housing prices. Our financial system is simply not fragile in the way it was back then. The risk of a widespread banking collapse triggered by housing is incredibly low. So, if we're not heading for a 2008-style crash, what are we seeing? The best way to describe the current market is a correction or a rebalancing. For years, the market was on fire. Ultra-low interest rates and a pandemic-fueled rush for space sent prices into the stratosphere. That kind of growth is just not sustainable. What's happening now is a natural and, frankly, healthy response to higher interest rates. The market is cooling from a boil down to a simmer. Demand has slowed because of affordability challenges, and this is giving supply a chance to catch up. Price growth has stalled, and in some of the most overheated areas, we're seeing modest price declines. This is not a crash. It's a return to a more normal, balanced market where buyers have a bit more power and prices are more aligned with economic fundamentals. Now, this doesn't mean there's no pain in the market. First-time home buyers are facing a really tough environment. The combination of high prices and high rates makes it incredibly difficult to get a foot on the property ladder. And yes, certain regional markets, especially those that saw the most extreme price surges and speculative activity, are more vulnerable to larger price drops. If a city saw prices jump 50% in 2 years, a 10% correction is not a catastrophe. It's a necessary adjustment. But these are localized issues. They don't pose a systemic threat to the national housing market or the broader economy. We're talking about specific pockets of weakness, not the widespread domino effect collapse we saw in 2008. The key takeaway is that the conditions that created the 2008 crisis, systemic bad lending, no homeowner equity, and a fragile banking system, are just not present today. So, to wrap it all up, is the US housing market going to crash in 2026? All the evidence suggests no. We are not repeating 2008. The foundation of today's market is built on solid lending, high homeowner equity, and a well-capitalized banking system. What we are experiencing is a much-needed market correction. A cool-down after a period of unsustainable growth. It's a rebalancing act, not a free-fall. While some local markets may see prices fall, a nationwide catastrophic crash of 30% or more is extremely unlikely. The housing market is cyclical, and this is just part of the cycle. It can be a difficult time for buyers, for sure, but it's crucial to understand that a correction is not the same as a crash. The fundamentals are simply too different this time around. What do you think? Are you seeing signs of a crash or a correction in your local market? Let me know your thoughts down in the comments below. I read every single one. And if you found this breakdown helpful and want to stay informed about the economy and your finances, make sure you hit that like button and subscribe to the channel. It really helps us out. Thanks so much for watching, and I'll see you in the next video.